Happy Inflation Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, December 13th, 2022. Starting with our economic release spotlight. If you guessed we're going to talk about inflation this morning, guess what? You are correct. So, some pretty significant dovish data. I'm less concerned about the dovish surprise relative to consensus expectations. That's mostly noise as it relates to managing risk from a Fed reaction function perspective. But the actual data came in pretty substantially dovish. So I'll just go down the list and I'll flag the most important things first here from our perspective in terms of the data that are released at 8:30. Don't forget there are two batches of inflation data that get released when the report comes out. There's the 8:30 that comes out from the BLS, and then there's the sort of, usually by 12:30, 1 o'clock, we'll get the underlying inflation gauges from the Cleveland Fed and Atlanta Fed. But just in focusing on what we got from the BLS this morning, I said to our subscribers, and I've been talking about this, the number one thing you got to focus on in the 8:30 report, the thing that the Fed has most control over as it relates to its reaction function, either up or down, tightening or easing, is services less rent of shelter. And when you look at services less rent of shelter, we had a dramatic breakdown. So we saw a 260 basis point deceleration to 3.2% in November on a 3-month annualized rate of change basis. That 3.2% is the lowest print we've seen since October 21. So October 2021. So that's a pretty significant breakdown in, again, the thing that you get out of the 8:30 report that is most directly correlated to the Fed's reaction function. So again, we don't necessarily expect Jay Powell to say anything materially different from where he's been, going back to that talk he had last Wednesday, or was it 2 Wednesdays ago? I'm losing sight. I'm losing sight on everything. But going back to where he was back then, I don't expect too much a deviation from that tone. But what I think is interesting about that tone that the market picked up on, and I think you're going to see with respect to potential dissents tomorrow, with respect to maybe even an amendment to the FOMC statement, is that there are more doves on the committee. And quite frankly, the doves have been rewarded by the data. And if I can say one thing about the data, this is the first time I've been analyzing, U.S. economic statistics, global economic statistics for nearly 14 years now. This will be the first time in the history of the U.S. core inflation that it breaks down ahead of a hashtag actual recession if it continues down this very aggressive path that we've really observed in the past 2 months of data. So again, the jury's still out on whether it will continue to break down, but certainly what we observed in October, November is pretty historic relative to the context of the business cycle, because typically inflation only breaks down after you see the business cycle really deteriorate from an employment and in consumption and investment and production perspective. We're seeing a little bit of decline in production. Not much of investment still technically running, growing above trend, as is consumption, as is employment. So 3 of the 4 main indicators for hashtag actual recession are actually growing above trend on a 3-month annualized rate of change basis. So this is very, very unique. Not just unique, it's historic. We've never seen this in the data series before, but it's happening. So we have to react to it from the perspective of being investors with capital at risk in financial markets. Getting back to the broader report. So headline inflation that decelerated 10 bips to 3.7% on a 3-month annualized rate of change basis. That's a 2-month low there. Food inflation decelerated 120 basis points to 7.6% on a 3-month annualized basis. That's the lowest print we've seen since August of last year. Energy inflation actually accelerated despite the move we've seen in crude oil prices, accelerated 1,370 basis points to down 7.7% on a 3-month annualized basis. That's the highest print we've seen since July of 2022. Of core inflation decelerated 150 basis points to 150 basis points to 4.2% on a 3-month annualized basis. That's the lowest print we've seen since October 21. Now, obviously, 4.2 is double the Fed's average inflation target, but again, moving in the right direction at a very expeditious clip. To quote Powell, we're seeing core goods CPI decelerate 390 basis points to minus 3.5% on a 3-month annualized basis. Minus 3.5% on a 3-month annualized basis. That's the lowest print we've seen since May of 2020, going back to the COVID lockdowns. And then lastly, core services inflation decelerated 60 basis points to 7% on a 3-month annualized basis. We all know that shelter inflation is what's dragging that, keeping that very elevated. Shelters at 8.7% 3-month annualized. But again, if you look at services inflation ex rent of shelter, which we all know is coming down at some point in the first half of next year, or the shelter component rather, Core services excrement and shelter minus 260 basis points to 3.2%. Again, the lowest print we've seen since October 21. So unequivocally dovish inflation data. There's no ifs, ands, or buts about it. Again, this is very rare. It's very historic relative to the context of the inflation time series and its relationship to other aspects of the business cycle, which continue to be growing above trend on a generalized basis, in terms particularly with respect to consumption and employment. You're not supposed to see inflation break down like this when those things are happening, but guess what? It is happening, and as investors, we have to respond to it and sort of reposition for what we believe is the next play coming out of DC from the perspective of Fed policy. So staying tuned for that. For 42 Macro subscribers, we're obviously not going to give away any risk management information away for free. Our team works very hard to produce that risk management information, and it's haven't had the best, let's call it 4 to 6 weeks totally, but we've had a fantastic year. We've really going back to, November of last year. We've done a hell of a job helping investors manage risk. We expect to continue to do a hell of a job helping investors manage risk on a go-forward basis, irrespective of some of the mistakes we've made in the last month or so. So anyway, getting into my Longbow dashboard, starting with global macro, we got a dollar that's been bearish from a short-term and medium-term perspective, very much presaging all the dovish inflation data that we were seeing on our screens. That's kind of in the middle of its probable range. Gold been bullish on both the short-term and medium-term basis. Also, very much presaging the dovish inflation data that we're now seeing on our screen. So it's not that someone knew something, but it was you start to see the signals. And I think one thing that sort of made these signals less believable was this move in China COVID reopening. If this move happened outside of the context of that, it would have been a lot easier to understand that this was presaging dovish inflation data in the U.S. But certainly China had a contributing factor to the move we're seeing across global currency markets and including gold as well. 10-year, that's been bearish from a short-term perspective, neutral from a medium-term perspective. Will it break down to bearish? We shall see. S&P 500, that's neutral from a short-term perspective, bullish from a medium-term perspective, getting towards the upper boundary of the range, but not quite there yet. CB VIX was at the upper boundary of the range, and it's now coming back down. That's been neutral from a short-term price momentum perspective, both bearish from a medium-term perspective. NASDAQ 100, that's neutral short-term, bearish medium-term, in middle of the range. Same. Russell 2000 been bearish on both durations. That may change. We shall see. But that's in the middle of the probable range. Bitcoin, that's bearish on both durations, getting towards the upper boundary of the trading range there. Ethereum's neutral short-term, bearish medium-term. That's towards the upper boundary of the range there. Shanghai Composite, that's double bullish. And WTI crude oil, that's been double bearish. Also, both of those in the middle of their respective ranges. So again, not a lot of actionable signal today, but certainly from the perspective of the momentum indicator here in the Longbow dashboard, really presaging a lot of this, what we're seeing on our screens today, and certainly what we've seen over our screens over the last, let's call it 4 to 6 weeks. So congrats to Longbow for nailing it. Anyway, getting to my free daily alpha tab, where we sort 300 ETFs, all representing individual factor exposures across global macro, in terms of the odds column, so to give you an indication what's most overbought versus most oversold. So in terms of what's most overbought this morning, you got things like the Qs, mega cap growth. Those are the kinds of things that are going to be up a lot today, or are up a lot today in the context of this inflation report. You may want to think about booking some gains if you had some upside right tail risk exposures position for that. Wink, wink, for those of you who do subscribe. And then lastly, sorting by the odds column. Get back to it. Oh, what the hell, Siri? Sorry, my apologies. Siri's interrupting the macro minute. How you doing, Siri? Anyway, get to the most oversold here. We got things like rare earths, Africa, Brazil, South Africa, UAE. These are the kinds of exposures that if this inflation data really does do a historic path lower, stay on this historic path lower ahead of a hashtag actual recession, you might start to see the markets really start to price in a global recovery that's aided and abetted by what could, emphasis on could, a pivot in Fed policy that comes sooner than investor expectations. So as I mentioned, 42 Macros subscribers, stay tuned for incremental updates in terms of what to do from a risk management perspective, but also on our deeper thoughts on the Fed reaction function heading into tomorrow and into next year. So with that, Darius Dale presenting our macro minute for Tuesday, December 13th, 2022. Best of luck out there, and we appreciate you for tuning in. Cheers.